Understanding the difference between tax credits and tax deductions is crucial for maximizing your tax savings. Both tax credits and tax deductions can help reduce your tax liability, but they work in different ways. First, let's explore tax deductions. Tax deductions are expenses that can be subtracted from your taxable income, which in turn reduces the amount of income that is subject to tax. For example, if you have a taxable income of $50,000 and you have a tax deduction of $10,000, your taxable income would be reduced to $40,000. On the other hand, tax credits are direct reductions to your tax liability. Unlike tax deductions, tax credits do not reduce your taxable income, but instead reduce the amount of tax you owe. For instance, if you owe $10,000 in taxes and you have a tax credit of $2,000, you would only owe $8,000 in taxes. To illustrate the difference, consider a tax deduction of $1,000 and a tax credit of $1,000. If you are in a 20% tax bracket, the tax deduction of $1,000 would save you $200 in taxes, whereas the tax credit of $1,000 would save you the full $1,000. It's also important to note that tax credits can be further classified into two types: refundable and non-refundable. Refundable tax credits can result in a refund if the credit exceeds the amount of tax you owe, whereas non-refundable tax credits can only reduce your tax liability to zero, but not result in a refund. In conclusion, while both tax credits and tax deductions can help reduce your tax liability, tax credits provide a more direct and often more significant reduction in taxes owed. By understanding the difference between these two concepts, you can make informed decisions about your tax strategy and maximize your savings.